Yo, what's going on, guys? Cruisc here, and today I'm going to be teaching you guys how to use Market Maker X models in day trading, as well as I'm going to give you guys a few tips and tricks that I've learned while using Market Maker models to help you increase your win rate and also increase overall bias and direction within the markets. So now we can talk about what is a market maker model, right? A market maker model is an idea or concept that's kind of based around how markets move and how we think large banks and institutions target liquidity. In the next slide, I'll show you guys a little bit of what it kind of looks like. You guys can kind of see the outline of this. But yeah, so kind of just an idea of how institutions and smart money target liquidity. It can take place on any time frame, and it is used as a confluence, not an entry model. So the difference between a confluence and an entry model is a confluence is like a reason why you're looking to get into a trade or confirming a bias that you have. An entry model is a way of getting into the market rather than just a reason for getting to the market, right? Hope that makes sense. So now let's get into how to spot a market maker model. This is the general outline, and the first thing that we want to do is identify the high time frame PDA rate where price may bounce. So in this example, let's say that price action is bearish, right? We get this first bullish price leg, meaning that we're pulling into probably a premium or a high time frame PDA rate or objective, or even a liquidity sweep that we have created at this top point. And then we get momentum down. We break this old low, creating a market structure shift. So then we quickly run all these old engineered lows to the objective or draw on liquidity that the market has. One way that you know that a potential market maker model is coming up is if we have a ton of old lows or highs. Now, you do need to make sure that you're not pattern trading this and just entering whenever you think, because a lot of the time you will get stopped out and you will lose. So make sure that you are using a proper entry model. So we need to be looking for a ton of old highs or lows that have been built up. So in this example, you could see we have 1, 2, 3, 4, 5, 6 lows. And then you could see in this price, like we only created 3 lows that we end up sweeping out very quickly. And like I said earlier, usually the first half of the market maker model, so this bullish price leg, will typically be a lot slower and a lot more choppier, but it'll be choppier in terms of going to the drawn liquidity and not just in a consolidation or in a range and just sitting there going sideways. Now this first half will be choppy, and then the second half should be relatively quick, and it should sweep out all these lows pretty fast. So now we can go over this again. First things first is we're going to have a draw on liquidity or identify an objective in which we expect price to bounce off of. Our second thing is we need to look and see if we have any old lows that are being engineered on this bullish price like to this high time frame PDA rate or objective. The third thing is we're then going to want to use our entry model to then find an entry to be able to take shorts, obviously in this example, but in a bullish example, it'd be longs, and then find out where we expect the price to then take out. So what does a market maker model look like in price action? So in this picture right here, if we look to our left, we'll see overall bias bullish. So our overall bias in this entire example is bullish. Then we have old highs left untouched. So if you look to the left of this entire picture, you'll see that we have 1, 2, 3, 4, 5, 6 prominent highs that we have left over that have been untouched. Then we see that we tap into a daily fair value gap or an FVG. So you look down here, the gray box is actually going to be the fair value gap. So we end up eventually pushing through it a little bit, and then we start to reject and then push up huge back bullish off of these 3 white candles, and this is showing that we are rejecting that daily fair value gap. Next, huge displacement out of fair value gap or high time frame PDA, and then you can see for our last point we quickly ran all old highs. So you can see after we rejected this fair value gap, we quickly ran 1, 2, 3, 4, 5 highs, and then we start to consolidate for a little bit, and then eventually took out that final external buy side liquidity. If you're looking at this chart at face value and you look at this left side of the half, right? So from this bottom point, you'll see that we engineered all these highs, and see how long it took. It almost took a third of the time to take out all these highs than it did to engineer all this, right? Usually the first half of the market maker model is going to be a lot slower, like a ton slower. And then we compare it to the second half or the ending portion of the market maker model, and you'll see we took it out fairly quickly. Now we can think about ways to trade the market maker models. So there are going to be 2 ways that I recommend to trade the market maker models. Number 1 is going to be ICT Silver Bullet, and the number 2 would be my personal inverse fair value gap model, similar to the Silver Bullet, but just with inverse fair value gaps. So first things first is we're going to be looking for a liquidity sweep and high time frame fair value gap. So you'll see in this picture, we actually did tap into a zone right here. I just didn't mark it out, but up here where we have the SMT, this is where we tapped into a zone. And then we see a market structure shift, which is going to be this old low right here. So you can actually see on this low, we did get a 1 minute body through it, showing that we do have a market structure shift. And then what I waited for was I measured out equilibrium of this price leg, and then we took the breaker block, aka the unicorn entry, with stops above the high, and then we entered off the fair value gap within that market structure shift, and then we just targeted a 5-minute fair value gap, in which you can see TPE got hit. So that was a very small, brief explanation of the ICT Silver Bullet being paired with the market maker models. So you can actually see we tapped into a high time frame P array up here. I act like I have it marked out, and then we have all these engineered lows down here that we then pushed down to then take very quickly. You can see how quickly we took it compared to how long it took for us to make it. And that is the ICT Silver Bullet. I will leave some videos in the description helping you guys better understand the ICT Silver Bullet and have better, more in-depth explanations of it rather than just this video, because this isn't the main topic of the video. However, in the future, I may make a video on the ICT Silver Bullet as well as my personal inverse fair value gap model, which we can go over right now. So in my personal inverse fair value gap model, if we look at this picture on the right, this is going to be the 15-minute time frame. So you'll be able to see all these lows that got engineered right here, right? So you see them all got put into place, and then we have this objective way down here, which is the previous day low. So now, once we see this giant fall off, now I'm looking for an entry model, right? So how can I get into the markets? This is when my personal inverse fair value gap model comes into play. So first thing I see is a liquidity sweep or a high time frame fair value gap. Now we see that we actually did inverse a 4-hour fair value gap, and then we swept an internal 1-minute/5-minute high. And as you can see in this price leg that pushed up, we did leave a fair value gap that I'm expecting to get inversed. I then enter shorts once I see this fair value gap get inversed, and I put my stop at the candle body's high right here. So now what I'm looking for is price to then quickly start to come down a little bit. And you can actually see we sat around for a little bit. This is about 4 or 5 candles, 5-6 candles maybe. And then we started to push down. We took out the internal low. And then as you see over here, we took out a bunch of lows right here. I went break even at this internal low, and then we had TP1 at the ES previous day low. So once ES took the previous day low, I took TP1, and then I moved my trailing stop down here, and then I just let price run until my final TP, which ended up being the 1 hour's body, which ended up actually being the -2 of my standard deviation. But you can see these are two different models, but perfectly traded market maker models. It's just finding the entry model that works for you. I will go over both of these models in the future, and I'll break them down. This portion of the video is just going over a brief description of how you can use market maker models to your advantage and still end up getting winning trades. So that's going to be it for today's video. I hope you guys enjoyed. I hope you guys learned what market maker models are. They're very simple to understand. This video may have been a little bit shorter on the end, but I don't believe that there's a lot to it. It's just kind of showing you what it is. But if you guys do want any more help, I will leave my social medias in the description below so that you guys can message me, or if you guys have any questions in the YouTube comments, I will make sure to respond to it. But yeah, anyways, hope you guys enjoyed. Hope you guys have a great day, and it's been Cruisc. Peace.